What is a bank run? A bank run occurs when a significant number of customers of a financial institution withdraw their deposits simultaneously due to concerns about the institution's ability to remain financially stable. As the number of withdrawals increases, the risk of the institution defaulting also rises, leading to more withdrawals. In some cases, the institution's reserves may not be enough to cover the withdrawals, resulting in a potentially catastrophic situation. How bank runs work. Bank runs occur when many individuals withdraw their funds from a bank due to apprehensions that the institution will exhaust its reserves. While these runs usually stem from fear rather than actual insolvency, they can eventually lead to a bank's financial collapse. To prevent such occurrences, banks are mandated to maintain a minimum amount of cash reserves either in a bank vault or with a central bank to mitigate risks associated with bank runs. However, as banks usually keep only a small portion of deposits as cash on hand, they must increase their cash position to meet customer withdrawal demands. One way banks achieve this is by selling their assets, often at significantly lower prices due to the urgency of the sale. Such losses in asset sales can raise concerns among customers, ultimately triggering withdrawals and exacerbating the problem. Examples of bank runs have been historically associated with the Great Depression, where after the 1929 stock market crash, depositors in America panicked and withdrew their funds, leading to a chain of bank runs in the early 1930s. To counteract these events, the U.S. government implemented regulatory measures such as creating the Federal Deposit Insurance Corporation, FDIC, to protect depositors with insurance coverage of up to $250. Despite the implementation of such measures, bank runs have still occurred in recent times. Examples include instances at Silicon Valley Bank, Washington Mutual Bank, WaMu, and Wachovia Bank. Silicon Valley Bank's collapse in March 2023 was due to a bank run caused by venture capitalists, resulting in customers withdrawing $42 billion. With $209 billion in assets, it became the second largest bank failure in history. Washington Mutual, WaMu, had about $310 billion in assets when it failed in 2008 due to a poor housing market and rapid expansion, with customers withdrawing $16.7 billion within 2 weeks. JP Morgan Chase later bought it for $1.9 billion. Wachovia Bank was closed after depositors withdrew over $15 billion within 2 weeks, leading to its acquisition by Wells Fargo for $15 billion. The withdrawals were concentrated among commercial accounts above the insured limit, preventing bank runs. To address the instability and chaos of the 1930s, governments implemented measures to reduce the possibility of future bank runs. One significant action taken was the implementation of reserve requirements, which obligate banks to maintain a certain percentage of their total deposits as cash reserves. Furthermore, in response to the numerous bank failures that occurred in previous years, the FDIC was established by the U.S. Congress in 1933 to protect bank deposits and instill public confidence in the nation's financial system. Under the FDIC's protection, deposits are insured up to $250,000 per account holder, in the event of a bank's collapse. In some situations, banks may need to take proactive measures to prevent a bank run from happening. For example, they may temporarily close their doors to avoid withdrawals of mass. President Franklin D. Roosevelt declared a bank holiday in 1933, which facilitated inspections to verify the solvency of banks so that they could continue operating. What is a silent bank run? When a large number of depositors withdraw funds from a bank electronically, without having to visit the bank physically, it is known as a silent bank run. This type of bank run is comparable to a regular bank run, with the difference being that the withdrawals are made through ACH transfers, wire transfers, and other non-cash methods. What is meant by a run on the bank? The term bank run originated from the situation where people rush to their bank to withdraw their funds, fearing that the bank might fail. If a large number of depositors do this at the same time, the bank can face a shortage of cash, as it operates on the principle of fractional reserve banking. This shortage of funds can ultimately lead to the collapse of the bank. Why is a bank run bad? Bank runs can trigger a harmful cycle that can lead to the downfall of banks and even sparks a larger financial crisis. As a bank typically holds a fraction of its total deposits in cash reserves, a surge in withdrawal requests from panicked customers can quickly deplete the bank's available cash. This can result in the bank being unable to fulfill all the withdrawal requests, leaving some depositors without their funds. If you found this video informative and entertaining, don't forget to hit that subscribe button and stay tuned for more content like this.